Advisory services offered through VestGen Advisors, LLC, an SEC-registered investment advisor. Securities offered through Private Client Services, LLC, member FINRA and SIPC. Private Client Services and VestGen Advisors, LLC are unaffiliated entities. Any information discussed does not constitute investment advice. VestGen Advisors and Private Client Services do not offer tax or legal advice. People of Chicago, welcome to In the Know Radio with Craig Bolanos, co-founder and wealth advisor at VestGen Wealth Partners. You want help from someone you can trust, someone who knows what it takes to get retired and stay retired. Today, Craig's going to teach you what you need to know. So get ready to learn something that could change your life. Get connected to the show by calling 833-964-PLAN or go to getretiredstayretired.com. And now, here's Craig Bolanos.
Hey, good morning and a very happy Sunday to you. We're here to give you the sincere and actionable ideas that you need to improve the lives of yourself and your loved ones financially. And there is stuff trending in the media constantly about retirement preparedness because survey after survey shows that Americans are coming up short. Now, I know if you're listening to this show, that's not you because you're saving, you're investing, you're doing your best to grow, and you're doing your best to protect. But I was, just mesmerized by this article that I was reading where it talked about retirement mistakes that my boomer parents made that I am going to avoid. Now, I didn't write this, somebody else did, but I thought we could really break this down to get a sense, to get a pulse of what's happening in America today. And this article goes on to cite really 4 separate topics. And the first that I'm going to ask David, one of our lead advisors at VestGen Wealth Partners, to talk about is this. David, the article went on to say that retirement was the plan, but planning was never a part of the process. And when I think about that, and I think about the stories that I hear, some firsthand, some anecdotal, is so many people plan on retiring, but they really just don't make any plans. And then they're either thrust into retirement by circumstance, or they choose to retire without knowing all the facts. David, why do you think that happens? And then how do we avoid and cure that at VestGen Wealth Partners?
Well, Craig, a lot of times when I'm speaking with clients or potential families that we might work with, I often tell them we're the right fit for the right families at the right time in their lives. And I think a lot of people just get caught up in life. So they might be doing the right things. They're living within their means. They're saving into 401ks, into IRAs, but they're going through the motions. And so generally speaking, when we engage with a family, it typically comes at that inflection point in their life. And that could be changing jobs. It could be the last kid is out of the house and now there's a little bit more me time. But when folks are looking for a more thoughtful approach forward, that's usually when they engage a firm like VestGen. And that's when we start creating clarity on how all this stuff is going to work. So I think many people perhaps have the puzzle pieces, but they fail to start thinking ahead of how those pieces will eventually come together. And let's be honest, you only want to retire once. So it's not like you can test drive this very often. It's kind of like one of those things, you don't know it until you know it.
You're right. You don't know it until you know it because you got to experience it. And that's why people need to go out and seek advice. People need to go out and seek counsel, especially from those who know what it takes to get retired and stay retired. 833-964-PLAN. That's 833-964-PLAN. Connect with us online at getretiredstayretired.com. If you're just joining, I'm talking about this news article I read in preparation here for a Sunday morning. And it talked about from the perspective of a Gen Xer, which I'm a part of, wasn't written by B. It was talking about the retirement mistakes that this Gen Xer's boomer parents made. The first one being, hey, I'm going to retire, but they really didn't have a plan going into retirement. The second topic of the 4 is it said that this set of parents treated Social Security like a discount coupon. And it went on to say that there was just pressure pressure from coworkers, pressure from friends to just claim Social Security early. And that's what this author's parents did. They took it right away at 62. But David, when someone takes Social Security early, it could be the right move, but we got to do the math. I mean, if you're born 1960 or later, you take it early, you're taking a 30% pay cut. That's a 30% permanent reduction. And I think a lot of people just don't realize what the Social Security break-even age really is. So, David, when it comes to really monumental decisions, like taking Social Security on time, taking Social Security delayed, or taking it early, walk us through some examples of how you direct a client to make a choice that's individualized to them.
Sure. Well, you said it, right? All of this comes back to part number one, which is actually having a plan. I think there's an interesting dynamic out there where some people think that they have a choice. And I would agree. Folks that are very well capitalized for retirement have a choice. They can decide to take it early, on time, or possibly delay. But there's a lot of folks out there that don't have a choice because they have a limited amount of resources. So we need to start with the end in mind. How much money are we going to need on a monthly basis? What's a reasonable distribution rate based off the way you're invested? So how much could you withdraw from your portfolio? And then how much are we going to get from Social Security? Social Security is a very personal choice. I can understand why certain folks might want to turn it on earlier. Maybe they don't have a great family history, so they're nervous about longevity. Other people today tell me, hey, I've been paying into the system for the last several decades. I want to get some money out. But there's a whole bunch of things to think about when we're doing this. I think people discount it to what you said, Craig. They say, Social Security, it's a couple $1,000 a month. For most of America, that is a substantial portion of their monthly income. So we have to stress test it. We have to create a plan, and we run various scenarios. But I think for everybody out there listening, there's a basic break-even number, and that's around your 81st birthday. So if you live to 81, you were probably better taking it on time versus early, and certainly delaying. But the only way to figure this out is to run these different scenarios, less income taxes, less Medicare premiums, and figure out what's going to work for your family. Because what works well for one might not work well for someone else.
David, that's so well said. So I want you to take a moment and go out to our website, getretiredstayretired.com. That's getretiredstayretired.com. And when you're on that website, of course, you can sign up for a complimentary strategy session. Of course, you can find a time to connect with us in the real world at one of our public speaking engagements that we do throughout the Northwest suburbs. Or in this case, you too should download your guide for free called Optimizing Your Social Security in Today's World. Optimizing your Social Security in today's world. After all, we had the passage of the Social Security Fairness Act in 2025. That was a legislative game changer for many people who had non-covered pensions. And some of these techniques that David talks about, understanding early, on time, delayed retirement credits, or combo strategies can all be accessed through that guide. So download for free at getretiredstayretired.com, optimizing your Social Security in today's world. So David, as we round out the four things that sometimes boomers in the eyes of a Gen Xer maybe did wrong, it was planning on retirement, but not having the plan. It was treating Social Security like a discount coupon, always taking it early. Number three was just not getting an outside perspective. And I think there's a lot of roles that get filled inside of a family. In this case, the author's dad was in corporate finance. So it was just assumed that it was being handled in the same way his mom was a retired teacher. It was assumed that the household was running efficiently. But David, why do people delay getting advice, you think? And what advice would you give people on who to hire in getting advice? What should they be looking for?
I think people delay because life gets in the way. So they have other priorities that they need to handle. And where should they seek out advice? You should be seeking out advice from a team of folks that has a process, not a product. A product does not get anybody retired and doesn't keep them retired. A process is a documented strategy that evolves over time based off changes to the tax code, healthcare, economy, investment markets. So if anybody is leading with a product, that is not advice. We know what that is. But I think that's important to think about, right? Is markets are now, as we're talking, Craig, back to all-time highs. What a great opportunity for someone to go seek out advice, because if they need to modify or make changes to their strategy, they can do it within striking distance of the all-time highs. I mean, it's crazy to say that based off what's transpired the last 30 days, but this is a great opportunity for folks to get a second opinion and really start taking a more thoughtful approach and putting these pieces together.
833-964-PLAN. That's 833-964-PLAN. Get retired, stayretired.com. When you're on the website, check out all of our media content as we're all over the airwaves and the TV, not just on this station, but many others. Use that website, getretired, stayretired.com, to connect with us for a complimentary consultation or attend one of our free upcoming public workshops. And as David mentioned, Social Security. Download your guide for free today, Optimizing Social Security in Today's World. You're listening to Craig and David Bolanos with VestGen Wealth Partners on AM 560. The Answer.
You want more in the know radio? You want more in the know radio? You can't handle more in the know radio. Okay, yeah, you can. And it's on AM 560. The Answer. Welcome back. Here's more with Craig.
All right, I have been saying on this radio program for the better part of some 13, 14 years now that when it comes to investing, you almost always get a second chance. Now, I didn't say that for life, but when it comes to investing, you almost always get a second chance. And for you traders out there, I'm talking about those Fibonacci retracement levels. Nerd out with me. But for everybody who's an investor out there, David, when we talk about getting a second chance, apply that to today's situation for all of those who are looking to get retired and stay retired. And what are the action items that people should be taking? Because complacency is the largest danger in today's market and economy.
One of the things we don't want to delay is we don't want to delay building our cash reserves going into retirement. And what I mean by that is if we're retiring January 1st of 2027, I don't think it's a good idea to raise your cash reserves in December of 26. How do you know where the market is going to be? And as you pointed out, as markets enter green territory, back in positive territory, this is a second chance for people that may have been over allocated to risk assets to go ahead and maybe boost their cash reserves, or perhaps take some profits on some assets that have appreciated. Because think of how nervous people were 2 to 3 weeks ago. Having cash is a benefit. It is a benefit because if you are withdrawing from your portfolio, you want clear line of sight as to where your monthly withdrawals are going to come from. And if I was going to retire, at the bare minimum, I want at least the next 18 months of cash flow lined up and ready to go, just in case. Most of our clients have more than that, but at the bare minimum, I'd want 18 months. Part two is for all of those that might not be retiring soon. Having a little bit of dry powder gives them the opportunity to be buyers when asset prices decline. So to your point, Craig, I think complacency is a big challenge for people, but markets often do give people an opportunity to do what they should have done the first time. And we are getting that in the middle of April right now. So it's a good chance to go take a look at your portfolio and see if there's some things that you might want to shift around.
So this isn't about what you should do now. This is about what you should always do. When I say you always get a second chance not to make a first impression, you always get a second chance to do the right thing. We just did a round trip around the sun in a similar fashion to that through which we did last year. Remember the tariff tantrum, the massive fall, then we were back up. Well, guys, we're within striking distance of all-time highs on some of the indices. What are you doing to rebalance your portfolio? If you haven't been rebalancing your portfolio, you need to take a look and make sure you don't just have a pie chart. I visit with listeners all the time. I love it when you guys call us 833-964-PLAN. That's 833-964-PLAN. And people invariably talk that they're a 80-20 or a 70-30 or a 60-40. Well, that's your mixture between stocks and bonds. That's not a plan. And if you're 80-20, 70-30, 60-40, well, I've got news. Not all of your accounts should be the same. That's not how this thing should work. Some of your money needs to be invested in short-term debt obligations. You need to own short-term bonds, treasuries, asset-backed paper, commercial paper, high-yield money markets. Some of your money needs to be all the way on the other side of the barbell, invested for innovation that creates disruption. That is always a great long-term secular theme. And other parts of your portfolio deserve to be broad-based, diversified, seeking what I call beta, but you better do it the smart way. That's why we're big believers in concepts like direct indexing, which we're going to come back and talk about later in today's show. So if you too want to start thriving in retirement, not just surviving, go out to our website. That's getretiredstayretired.com. That's getretiredstayretired.com. Connect with myself. Connect with David. Let's talk about how we can help you start moving the needle so that you're no longer directionally correct, but you're doing every single decision with great intention so you too can get where you deserve to go faster and more efficiently, because it's all about getting a real return on your money. David, what were you going to add?
So let me ask you a question, Craig, because I thought one of the things you were going to bring up from this article, which clearly wasn't in it, was failure to invest capital in retirement, meaning that perhaps the author was saying that my parents didn't invest enough, so they didn't grow their capital. We often call those investors fallen angels, right? Maybe they had very safe investments and it felt good because there was little volatility. What's a fallen angel? And when you're talking about like barbelling strategies from high quality to safe assets, like, how do you determine how much investors should have in these different buckets? Because that's where I think a lot of people struggle. So what's a fallen angel? And then how do we determine what that mix needs to look like for every different family?
All right. So a fallen angel is this. It's the reason David and I do this show. There's a reason that our tagline is get retired, stay retired. It's a reason the website is get retired, stay retired. There is nothing more painful than us running into somebody through our TV, our radio appearances, where they retired early or they retired on time, and retirement was great because they spent 10, 12, 15 years living off interest, dividend, pension, Social Security. And then all of a sudden it was an event. It was not an event. It was a collection of tiny events strung together over years where someone realized they were actually running out of money because they weren't solving for the silent killer that was inflation. So these are a lot of people who maybe retired at 60 and now they're becoming a fallen angel at 75, 76 because they go, oh my heavens, I'm not going to have enough money because they haven't been properly investing through retirement. They only invested enough up to retirement. And Don't let that be you. Don't let that be you. Get with us today so you too can learn what it takes to thrive in your retirement years. Now, David, you also asked me a question, like, what's a barbell? I'm going to give you an example of like a barbell. Barbells can refer to bonds, owning short-term bonds that mature in a couple of years, pairing that with the other end of the barbell, bonds that are longer term in value. And you would do that depending on your outlook for yield curves and interest rates. But another form of a barbell is think about what's happening today. Right now, today, there's an area of this market that's under attack. It's under attack by artificial intelligence. And what's under attack by artificial intelligence? Software as a service. And I'm not going to give you individual names in the radio, but I'm going to talk about a sector. That sector is software as a service. These are great integrated technology companies that are deeply entrenched all throughout corporate America, from small to medium to large enterprise business scalable solutions that you're using to read documents in your computer. These are software as a service companies that you're utilizing to manage your HR, your customer relationship management software. And all of these stocks just got repriced. These stocks are down 30, 40, 50% in value. And are they going to bounce all the way back? No. But are they oversold? There's a good chance they might be. So an example of a barbell trade is investing in software, which is currently under pressure, while at the same time you're leaning into a trend that we call the defense replacement cycle. Guys, every time we send munitions into the Middle East, both for us to use, God knows I love watching bombs drop, in addition to all of our allies, those munitions need to be replaced. And in fact, I think we all know munitions not only need to be replaced, munitions need to be re-engineered. We're learning that. We should have known that from the conflict between Russia and Ukraine. And we're definitively seeing that with what I call straight line GPS drones and the autonomous drones of the future that are already here and coming in large waves. So a barbell trade, David, is where you take two sides, two different theories. In this case, right now, it's software as a service paired with the defense replacement cycle of those great defense stocks. I think those are the types of things that belong in people's portfolios, and they belong in people's portfolios regardless of what age they might be. Because again, if you want to get retired and stay retired, you want to thrive in retirement, not just survive, you've got to invest through retirement, not just to retirement, because no one can afford to become a fallen angel. If this resonates with you and you want to learn more about the defense replacement cycle, about how to take advantage of the dislocation in software as a service, give us a call, 833-964-PLAN. That's 833-964-PLAN. Go to our website, GetRetiredStayRetired.com. That's GetRetiredStayRetired.com. More sincere and actionable ideas that you can be using to improve the lives of yourself and your loved ones financially. Coming back after this, you're listening to Craig and David Bolanos. This is In the Know with VestGen Wealth Partners on AM 560, The Answer.
Would you like a dose of knowledge? Good, because Craig is back and about to fill your retirement prescription. Back to In the Know Radio on AM 560. The Answer.
Someone said to me the other day, it was a client that came on board recently, and they said, your firm is in the clarity business. And I had to have him repeat it because I'm like, what do you mean the clarity business? And it got into this discussion, something I've said on the radio before, that the world is drowning in IQ. Intelligent quotient. There is so much information at the tips of your finger, courtesy of the digital environment that we live in, but you've somehow got to take all of this IQ and turn it into a better form of IQ, which is implementation quotient. And it's taking the data, creating clarity of how that data intersects with you and your family so that it can be implemented flawlessly And that's what the new client was really thanking us for. And I'm so proud of it. So, David, give us some examples of how we provide clarity to the retirement and wealth planning process.
Well, let's talk about cash flow, because retirement is not about assets on paper. It's about what comes in versus what goes out every month. And that is oftentimes a very challenging question for a couple to answer. If I were to say to someone, what does it take to run your household on a monthly basis? I might have one family say, here's exactly what the number is. And I know that maybe they're tracking everything on Quicken or Excel. But we work with a lot of families that do very well financially, have higher incomes, and quite frankly, their feeling is, look, we make good money, so we spend what we need to, and we're still able to save. So we don't track every dollar. Part of our job, I think, Craig, is to set expectation of what it's really going to take. I had a conversation with someone the other day, and as we were building out the building blocks of their retirement simulation, I had said, so what are we planning on our baseline expenses? And she gave me a number, and I may have just given her a funny look. And she's like, why did you give me that look? I said, that's the number that probably works for your parents. That's not the number that's going to work for you. I know what your tax return looks like. We need to set a higher benchmark. So when we are planning for this, I always tell people, let's not shortchange ourselves. We're not talking about what's the bare minimum to keep the lights on. We're talking about active adult lifestyle so that you can retire to something and that you enjoy that lifestyle. Number two, we have to create some clarity around what your healthcare costs are going to be and what the real inflation rate on healthcare is. So your Medicare Part A, B, perhaps your Medigap supplements, Part G and D, or maybe you choose to go to Medicare Advantage. We should put that on paper and use realistic numbers with that stuff. In addition, it sounds like a small thing, but if you're retired for the next 30 years, you might have to buy a new vehicle. I mean, I looked at someone's retirement plan from 15 years ago. We had the new vehicle purchase listed at $25,000. I don't think you can buy a new vehicle for $25,000. So whether it's wedding, new cars, or vacations, that is a big one, right? We've seen global travel hit all-time highs. It is not cheap to take that European vacation. We could be talking upwards of $20,000 to $30,000. If that's what's in your future, let's plan for that accordingly. And I think part of the reason we do a good job of that, Craig, is we have a homogenous client group that is either on the very cusp of retirement or recently retired. And we kind of know what it takes to get it done, whether you live in Chicago, Florida, California, Arizona, or Rhode Island. We know where that sweet spot needs to be. And that is the starting block for financial planning is where do we need to be? All this investment stuff that we talk about, we fill in those gaps after the fact. We don't have a product, right? We don't have one size fits all. We have strategies to fill in the gaps once we figure out what those gaps actually look like. So to me, that's what clarity is. It's putting the stuff on paper and being realistic of what this is actually going to take to get it done. Because the worst thing we can do is shortchange ourselves and spend the next several decades of permanent unemployment in a spot where you feel like you just can't spend any money.
I think that's so critical because cash flow becomes king, and we want to help you do that. 833-964-PLAN. That's 833-964-PLAN. Go out to our website at getretiredstayretired.com. That's getretiredstayretired.com, and let us help you move through our VestGen vision process, because our vision process is going to help you crystallize a compelling vision of your future. It's what David just talked about. It's not just about the funds, but it's about what are you retiring to. That VestGen vision process is going to allow us to figure out the sequence through which you're going to withdraw monies all in a tax optimized solution to ensure that you have better priced retiree healthcare and long-term viability in the structure of your finances. Take advantage of that complimentary consultation today at 833-964-PLAN, 833-964-PLAN. Get retired, stayretired.com. David, when you go through that VestGen vision process, vision planning with clients, what are the takeaways that you think a lot of people receive just in the initial introduction to such?
I think things are more expensive than people recognize oftentimes. Now, they know what the numbers are, but we have to take a step back and say, let's be realistic about this. So first thing would be, if we have an aggressive retirement age and we're going to retire prior to Medicare eligibility, how much are we going to come out of pocket for healthcare premiums on the exchange, right? In 2026, there are not subsidies for everybody. So we need to allocate properly. We could be draining $20,000, $30,000 a year just on pre-Medicare retirement expenses. Number two, I think most families I engage with have a phased spending plan. To me, a phased spending plan is we worked really hard and now we want to spend some money. So we have a lot of things we put on the back burner, trying to get the kids through school, trying to have liftoff from the nest, if you will. And there are some vacations that we want to go on. And we need to be realistic with what those vacations cost, because the consumption rate, the first 10 years of retirement, might be a little bit higher than we initially anticipated. And I like to compartmentalize dollars and accounts, and we might just create separate accounts for retiree healthcare expenses or for some of this discretionary spending. But our job is to put those numbers on the board so that everybody can look around the room and say, yeah, you know what, that's what it's actually going to take to get done. And that's where we might fill in the gaps with some of those strategies you talked about before. If I know I need healthcare premiums, I'm probably not going to put that money in the stock market. I want it safe, earning some interest, so that money is there when I need to spend it.
Absolutely. We want your money to be there, not just when you need to spend it, but when you want to spend it. That's the difference between surviving versus thriving in retirement. I want you to take time and go out to our website. That's getretiredstayretired.com. That's getretiredstayretired.com. When you're on that website, download for free today our guide to the markets. You need to understand why 2026 is about higher stakes that come from higher valuations leading to anything but dull, right? Download that guide for free today and take advantage of that complimentary consultation. Request a visit directly with David or request a visit directly with myself. We'll make sure that we're available for you, whether it's via telephone, in person, through the computer. We access everybody across the United States. All right, when we come back, we're going to give you some more hard-hitting action that you need in order to be successful. We've talked about it before, but we need to review in better detail those 6 items for 26, the 6 key items that people ought to be doing and in consideration, because I think, just as we said, you always get a second chance to do the right thing. Timing is critical on the 6 for 26, and this is something that is prime for spring of 26. You're listening to Craig and David Bolanos in the know with VestGen Wealth Partners on AM 560, The Answer.
It's more In the Know Radio with Craig Bolanos on AM 560 The Answer, where his goal is to pummel you with financial know-how until you say uncle.
All right, we've talked before about our 6 items for 26, but let me set the stage again. Our investment theme of 25 was pragmatic optimism. And remember, we were spot on. We are 100% correct. You were correct to have pragmatic optimism. In 2026, here we are. We're in April, and I got news. Our theme of higher valuations, higher stakes, anything but dull, it was perfect. It was spot on. That does not mean we're omniscient, but it means we're doing our homework every single day to align our clients with strategies to grow and protect their wealth, knowing that fundamental decisions that are data-driven, let me say that again, fundamental decisions that are data-driven, not decisions based on sentiment, not decisions based on hunches and guts, no way, but decisions that are data-driven lead to a systematic, repeatable experience, and that's what you need if you want to win throughout retirement. Now, David, number one, we called it buy the dip, sell the rip. And what you really meant was to be what?
Was to be active, not active as a day trader, but not to be complacent. So I'll give you a couple examples. One, if you came into the year when the stock market was at all-time highs, perhaps you needed to lighten up your equity exposure, de-risk a little bit, knowing that the fourth year of the bull market just becomes a little bit more challenging. Number two, it could be perhaps you got over allocated to one sector of the market. You needed to take profits and move some of those profits to parts of the market that were a little bit cheaper. So just some normal rebalancing. Or number three is, hey, look, we've done really well. We've made it in retirement. We're going to put some dry powder on the sidelines, and we're going to hold on to that cash, knowing that there's a lot of stuff going on in the world. But the key is we don't want to just have a good idea. We actually need to go ahead and execute on that idea. That's what we mean by, fix the roof when the sun is shining, or buy the rip buy the dip and sell the rip. Let's go on to number two, Craig, which is
David, before number two, I want to give someone something that we talked about earlier today. When we set a barbell strategy, going ahead and purchasing software as a service into the weakness, because all those stocks are on sale, while at the same time you lean into a growing arena, which is the defense replacement cycle. That's an example of being more active amid the complexity, and we want you to participate too. Connect with us online, getretired.stayretired.com. David, what was number two on the 6 for 26?
Well, number two was going global. And one of the concepts I think about going global is, as we entered 2026, the top 10 stocks in the S&P 500 represent 39% of the index. Now, that can have two results. If those 10 stocks do really well, because they're almost 40% of the index, they will pull the whole index higher. On the flip side of that, though, if those stocks struggle, they're going to pull the index down. That's the highest weighting they've ever had. Reminds a lot of people of 1999 during the last technology bubble. Not saying that's where we are today, but I think that was a sign for people to perhaps look elsewhere, perhaps outside of the US. And part of the catalyst for looking outside of the US is, since we announced the tariffs, we have a weaker dollar, and that weaker dollar helps investors when they invest outside of US borders. So if you're looking for cheaper valuations, we want to play this weaker dollar. That's a way to certainly take a look and execute on that strategy.
You got to be paying attention to de-dollarization. It's a real thing. If you want to protect your wealth and grow your wealth and outrun the silent killer that's inflation, ask yourself and ask your existing money manager, what are you doing to hedge de-dollarization? And if the answer is, don't worry, the U.S. is going to remain the world's reserve currency, yeah, that's a starting point. But listen, follow the money flow, everybody. Understand what it means to generate a real return. That's a return after inflation, including currency inflation, a return after taxes. That's what you got to be thinking about. And de-dollarization is real. And if you're not going global in your portfolio, you're missing it. We enjoyed 14.6 years of U.S. dominance. 14.6 years, I say it again, of U.S. dominance. The typical cycle only runs 8 calendar years. I say again, it only runs 8 calendar years. Think about what created that dominance. It was the mass amount of quantitative easing, the mass amount of balance sheet transactions from the Fed, the mass amount of printing money, printing stimulus, the mass amount of ZREP, zero rate interest policy, the ginormous overhauls to the tax code, the largest tax cuts in 36 years. How much more of that's going to come? It's probably not. So make sure you're working with advisors that know what it is to hedge. 833-964-PLAN. Connect with us online at getretiredstayretired.com. Number 3 on our 6 for 26 is that shifting paradigm for portfolio construction. Remember, the next frontier of investing is not a new asset class. Rather, it's a new way of giving people access. David, if President Trump wants to give people a new way of having access, I think we should listen. What's he talking about?
Yeah, I like to, we love acronyms, right? So we used to use the acronym HELP. I got a new one for you, Craig. It's HALO, hard assets, little obsolescence, right? So think of investments where there is a finite amount of resources, where AI is not going to take over. And I can give you lots of examples, but a general term would be infrastructure. Now, infrastructure can come in the form of traditional infrastructure, like transportation. Energy is a part of infrastructure. Clearly, that's a concern right now. But it's not just a concern because of Iran. This was a concern for Europe due to the political conflict between Russia and the Ukraine, right? Europe's very dependent on Russian oil. They're looking for alternative ways. Corporations are getting into that. We also have digital infrastructure. If you believe in the semiconductor stocks, well, then we need the backbone or the skeleton of that AI infrastructure. That's what I mean by digital. And one of the other things you had mentioned, Craig, I also think of as infrastructure is defense spending. Now, again, not just because of the conflict in the Middle East, but on average, defense budgets have increased 20% since 2024 in Europe. That's a massive amount of spending as other countries in Europe rebuild their defense sectors. So follow the money. There's a lot of good thematics to tie onto. And these aren't short-term thematics. These are long-term thematics that investors can play in several different ways.
Long-term secular themes. And thank God the great defense companies of the world happen to be great companies of America. Absolutely, David. 833-964-PLAN. GetRetiredStayRetired.com. In addition to that, David, it's cheesy. The Olympics were this year, but you coined it. You said number 4 on our 6 for 26 was focus on quality, because quality is going to take the gold. Why is investing in cash cows that have such great free cash flow important in today's environment?
Markets are like politics. Typically, the pendulum swings too far one way, and then it tends to come back towards the middle. And that's what we've seen. We had some stocks in very growthy areas of the market that had to get repriced lower because they got a little extended. So the pendulum's moving back to the middle, and some of these cash cow companies that run very boring businesses, those are the stocks that are getting all the bids. So this isn't a one or the other. It's just a reminder that in markets, part of being diversified is you never know what's going to do well. Who knew coming into this year that a small sliver of the S&P 500, aka energy, was going to be one of the best performing sectors of the market? This is why you need to constantly rebalance your portfolio, because you never know what's going to come through.
Because when you focus on quality, large cap companies with high free cash flows, it gives you exposure to that area of the market where sustainability happens. I'm not talking about sustainability of green. I'm talking about sustainability of the cash, sustainability of the earnings, which means there's attractive upside. We're talking share buybacks. We're talking dividends. That's what cash cows are, can, and should be, and that's why we want them in your portfolio. 833-964-PLAN. Get retired. StayRetired.com. Craig and David in the know. VestGen Wealth Partners on AM 560.
Okay, Windy City, get ready to be blown away with a hefty gust of financial know-how. You're listening to In the Know Radio with Craig Bolanos on AM 560. The Answer.
We talked about retirement pitfalls in the A block today, followed by 6 for 26 and creating clarity for your family's retirement. I want to spend some time talking about clarity again, because when we are engaging with families, it is not because those families are not already doing the right things. These are folks that have been saving in 401ks and IRAs. They're mindful of their spending. They perhaps have already put pen to paper and have drafted estate and legal documents to protect the ones they love. But there is a recognition that comes at a certain time in your life. I call it an inflection point. It is when you change jobs. It is when the kids go off and get married and you're ready to start that next chapter in life. And that inflection point causes people to start rethinking what they're doing. And if you've been thinking out there, hey, I feel like I have the parts, but I don't have a plan around the parts, we're here to tell you there is a different way to do things, a higher level of care, and you deserve to level up. If you're frustrated that you are always the one driving the action in your portfolio or driving the changes to the retirement plan, the difference that we offer here is we are a family office for Main Street families, families that have done a good job, that want to start creating some synergy between their investments, their tax return, their cash flow plans, and their estate plan. And as you're thinking about it, I think really good investors and savers are starting to understand something. You don't deal in absolutes in financial planning or investing. There's not a product to buy. There is a process you have to go through. And that process is often at times about winning at the margins, squeaking out a little bit extra on your taxes, making sure you capture that full senior bonus deduction, making sure you do smart Roth IRAs, making sure you have lower cost investments, not having too many large capital gains. And the way that we deliver that is we have a team approach. We create a single hub so you have one place to go to coordinate care and create that synergy. So I would encourage you, go to our website, GetRetiredStayRetired.com. Download our guides or give us a call. You've been listening to In the Know with Craig and David Bolanos on your favorite station, AM 560, The Answer.